Chapter 5, and this chapter is on job costing. When you're looking at costing, depending on the type of industry that you're looking at, you can use either job costing or process costing. So job costing is when you can distinguish one unit from another. So if you're making, one-off items like a piano, if you're a law firm or accounting firm. So, if you work in an accounting firm, you have to track all your hours that you spend on each client. So that would be, each client would be considered a job. So that's job costing. So process costing, that's used when you're doing large quantities of identical units. And you're just going to sort of average out all your cost over all the units. So think about if you're making a soft drink or you're processing oil, those types of things. So they would be using process costing for that. So just some examples of whether something is process or job costing. So a manufacturer of fiberglass insulation, that would be process costing. A residential plumbing contractor, job costing, because he's going to track the cost for each customer. If you're manufacturing fiber optic cables, that would be process. Manufacturing home-based jewelry, job costing. And a hospital would also be job costing. With this chapter, what we're really doing is following the cost through the whole process from the time you purchase your raw materials until the product is made and ready for sale and then ultimately sold. So when you buy your materials to make your product, it goes into raw materials. Then as you take it out of inventory and you start to use the materials to make whatever product you're making, then when the product physically moves, you're also moving the cost. So the cost then moves from raw materials into work in process, which is also an inventory account. Then when you finish making your product, it goes into finished goods inventory. So it's still on your balance sheet, it's still an asset, but now it's a completed asset. So it doesn't leave the balance sheet until the product is actually sold. And in that case, then the cost moves to the cost of goods sold, which is on your income statement. So here you can see the cost coming in for raw materials, and the $1,000, typically what happens is you start your period with $1,000 in inventory. You usually start off with some inventory left over from the previous period. So then during the year you buy $100,000 worth of material, then you move $80,000 of it out to your work in process inventory. And then when it's finished, so what happens here is you have your work in process inventory along with your other cost, and then all of that moves to your finished goods inventory. So what makes up your work in process is your actual inventory itself, then you have your labor and your overhead. So then you move this to finished goods inventory at your $90,000, and then the next stage is when it actually is going to be sold. We take the $80,000 out of finished goods inventory and we move it to our cost of goods sold. So basically the dollars will follow the physical movement of the inventory, if you think of it that way. When we're looking at cost, it's easy enough to trace your direct materials, direct labor, but the overhead, that's one that can be a little bit more challenging. So we want to be able to understand what the cost, the true cost to make the product is. So like I say, we know what the materials are being used, we know how much that costs, we know how many hours of labor goes in, so that's not so bad. But now we need to figure out how much overhead we're going to be allocating, because we need to have the full cost picture so we know how much to sell the product for. So one way, probably the simplest way, is to calculate the predetermined overhead rate. So what you do is you estimate at the beginning of the year, based on your historical spending, how much your manufacturing overhead is going to be. Then you have to estimate the amount of the allocation base. So if it's more of a manual operation and direct direct labor would be probably the cost driver there. So here you would take the overhead allocated to the job and then you would add it in that way. So here is the example. So if you are estimating your manufacturing overhead, it would be $1 million. And you're estimating you're going to pay 62,500 direct labor hours. So what we would do here is take your $1 million in overhead, divide it by direct labor hours. That would give you $16 per direct labor hour. So what this means is for every hour that somebody works on the product, you're going to be adding, in addition to the materials and labor, you're going to add $16 for the overhead cost. When you look at the cost of a job, if you're doing job costing, you trace the actual materials and direct labor to each job. You can do that because you have your materials requisitions and your labor time records, so that's easily traced. The overhead is allocated then based on this predetermined overhead rate, and it's all based on estimates. Because your total overhead that you're expecting is just an estimate, and the total number of labor hours is estimated, what will happen is at the end of the year, you're going to have a bit of difference. Once you know what the actual overhead is, it's never going to be exactly the same as you had predicted. It's always going to be off a bit. So you either would have your overhead cost either over applied or under applied. So then at the end of the year, you got to look at how much you actually allocated and compare that to what the actual cost was and adjust. This is what you would be doing. So here we've calculated the overhead rate was $16 per direct labor hour. And in this example here, we're looking at allocating the jobs based on actual direct labor hours. So it's an estimated overhead, but it's applied to actual hours. So here, the manufacturing overhead cost, we have our $25,000, and our manufacturing overhead that we've applied, it's $24,000, so it is under allocated by $1,000. So when the overhead, was calculated at the end of the year, when all the bills are in, you know exactly what you have in overhead costs, it turns out to be a bit higher than what you had estimated by $1,000. So you have to obviously adjust for that at the end of the year. So if the amount that you've allocated is greater than the actual cost incurred, then it's called over allocated. And if the actual cost turn out to be under, then you're under allocated. So what you have to do then is, of course, make the adjustments. So if you've over allocated, you've got to reduce your cost of goods sold by that amount, or if you've under allocated, you've got to increase your cost of goods sold. Why do you need to calculate the cost of jobs with such accuracy? Well, when you, for example, if you're bidding on a job, if you're a contractor and you're bidding on an extension to the university on a new building here, you're going to rely on previous cost estimates in order to help you make reasonable estimates to put in for a price that you're going to bid on a job. So you really need to have a good handle on your cost. So you have to also use it to compare different products that you're selling. So some products may be more profitable than others. You use the information for pricing decisions. So if you're not making as much money as you would like, maybe you have to increase your price. Or if there's a competitor entered the market, you might have to lower your price to match theirs. You need this information to make decisions on high volume sales, as I mentioned earlier, about bidding on contracts, and for financial statement presentation. So when you're looking at non-manufacturing costs, so with job costing, traditionally you focused only on the production-related cost to the jobs. Period costs are treated as operating expenses. So your period costs, you look at insurance on the building, depreciation, things like that. So they're treated more as operating costs. But managers do need to know the total cost of the product across the entire value chain. So you add add some of the non-manufacturing cost to the total inventoriable job cost in order to get the total cost of the product across the entire value chain. Now, this is only used for internal decision making. You don't use this method for GAAP or IFRS. So if you're using job costing, usually when we think of job costing, you think of, you're making an airplane or you're building a building, but job costing is also used at service firms. So as I mentioned before, it's used by accounting firms, law firms, etc. You have to track all of the costs for the time that you're spending working for each client. So there's no inventory, so it's not as complicated to do job costing for a service firm. In this example here, you have your job costing at a service firm. So you have your direct cost plus your indirect costs will give you the total cost of doing that job for that particular client. So that ends the PowerPoints on Chapter 5. And again, I encourage you to go to the demonstration videos that I have in the folder for this chapter, and that will give you more examples and help you see these calculations done again in a more detailed fashion.